Now, the horizontal demand curve might sound a bit strange. After all, aren't demand curves supposed to be downward sloping? Well, yes and no. What this does is highlight the difference between what we could call the market demand curve and the firm-facing demand curve. So the market demand curve will definitely slope down and to the right, reflecting the same first law of demand that we've talked about several times now. At lower prices, consumers will want to purchase more of this product than they will at higher prices. Let's go ahead and just put a supply curve in here, and we'll say that this is also equal to the market supply curve. And let's say that the equilibrium price is $2.50, and the equilibrium quantity is some quantity Q1. Okay? The firm-facing demand is going to be a horizontal line because at that price, they can sell as many as they are willing or able to produce. So let's call this one firm A. And let's put up a separate one called firm B. All right, price and quantity, they have the same horizontal demand curve at $2.50. Now, it's true that if firm A were to raise their prices by even 1 penny, all of the customers would flock to firm B. And the same could be said about firm B. If they raise their prices by a penny, all of the consumers would flock to firm A instead. However, firm A or firm B would not be able to produce any more pills than they are currently selling because of their marginal cost curve. Remember, this is the same thing as supply. And so here would be the profit maximizing amount that firm A could produce, and we'll call it lowercase q A. And this would be the amount of pills or product that firm B could produce, and we'll call it lowercase q B. Now, what's kind of cool is that if these are the only two firms in the market, then QA plus QB must be equal to capital Q, this here. In other words, if consumers are buying a total amount of Q1 and the only two places they can purchase that product are from firm A or firm B, well then they must have bought it from either firm A or firm B. Now, if firm A were to try to gain some competitive advantage by perhaps lowering their price, what they would do is they would actually be producing less. And so their revenue would decrease because if they charged a lower price, they wouldn't be covering the cost of this decreased production. And so they couldn't continue making QA if they lowered their price. They would be losing money every single time. Now, in this situation, we describe firm A and firm B as price taking or as price takers. Why we do this is because in this situation, firm A and firm B must accept the price of their product as a given fact of the world based on the market structure. And so they have to actually take that price as a given, hence the name price taking. So let's do an example of what happens if one firm actually innovates and creates a new way to produce this product. So let's say that firm A discovers a new way to produce this product that increases their ability to do so. Well, initially, what this will do is it will shift the marginal cost curve to the right, but only for them because firm B has not discovered this same new technology. So what happens is the market supply curve will shift to the right. That will lower the equilibrium price in the marketplace, let's say to $2. What that does is it lowers the price that these firms are able to charge to $2. Firm B faces the same constraints And now what's going to happen is firm A will produce more and firm B will produce less based on the decreased price. Firm B is going to be very, very unhappy about this. And so what are they going to try to do? Well, they're going to try to copy the same innovation that firm A has, which would then increase their supply here and get them back to some sort of a more competitive situation. So what we can see from all of this is the role that competition ends up playing. Why do firms seek to innovate? Well, if they can innovate, they can make more money. Because notice that the area underneath this curve here, right, this blue area here, let's do this. Let's think of it kind of this way. This area right here is revenue that is lost due to the lower price. However, this area right here is revenue that is gained due to the new price. If I had drawn this better, it would be clear that this area here is larger than this area here, which is why firms tend to innovate. Okay? Firm B, however, has just lost all of this revenue here because of firm A's innovation. That means they're losing money every single month until they can match this new innovation here. And what that would do is increase the supply curve in the marketplace by a little bit more, lower the price even further, and then we would see firm A reduce output and firm B increase output. And so what ends up happening is a competitive equilibrium would be reached where all firms have the same technology, the supply curve has increased, the price has come down.